Good evening, everybody. Filming just a little bit earlier today than normal because, quite honestly, I need to get to bed early and get some good sleep tonight. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms, and I'm back to talk about the stock market and our strategy using closed-end funds. So, the normal disclaimers: this is an unedited video. Who knows what all you'll hear in the background as I film these in my house. I am not a financial advisor. I am a strategist and a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So, uh, the weekly ask is that you help me push these videos out. My goal is two-part. One, I'm sharing what we're doing and why, because it makes me verbalize an argument for how we're investing in the market, because me thinking about it and staring at a screen is very different than explaining how I'm going about it. And to do that, I dispense a ton of information, almost like an information hub, to where I'm collecting information throughout the market and throughout sources, and then I render those down and then I present them by video. And I'm giving information that's very different than what most people hear when it comes to investing. From my angle, it's a better way to invest. It's creating a no withdrawal portfolio to where you're keeping your principal intact and you're living off dividends, or you're supplementing a retirement or supplementing your life off dividends. And it's not a 60/40 model, stocks to bonds. It's not a 4% rule. It's very different than the standard advice. And it's also very accessible. So instead of buying single stocks and paying a ton of money for single stocks and getting a really scanty dividend, we're buying in at a cheaper price. We're getting lots of access. We're getting inbuilt diversification without going into over diversification, and you're getting a hefty dividend. So instead of the 1.2, 1.3 dividends you'll see on average in the S&P 500, we're getting 8% plus, 9% plus. I think the current portfolio is 10%, almost 11%. So that's a very different metric, because what most people ascribe to versus pick your retirement plan is to amass an amount of money and then slowly, hopefully slowly, but really sell it off and sell off that principal over retirement. We're not doing that at all. Our goal is to generate money. Yes, grow our portfolio, grow our overall capital, grow our principal investment, and at the same time maintain that and generate dividends and live off the dividends. And there are companies who are paying fat dividends and really great incentivized rewards for owning their companies. So if you like my content, subscribe. If you like my content, like the videos, and comment on the videos and share the videos, because what helps the YouTube algorithm is those things: liking the content, interacting, sharing, but then also help somebody else. I mean, my job is twofold. My purpose is twofold. One, it's being able to explain what we're doing and why. And the other part is helping other people. And maybe that sounds backwards. I mean, the whole point of any business is to make money. The whole point of every channel is to gain followers. So if we can shift that aside, I started this to as really two-part. I can't section them out. I started this to help other people, but I also started it to explain what we're doing and why, and to show you that it's better than other advice you'll see elsewhere. So if you like my stuff, please share it. And if you have comments and you want to interact, then say something. And if you've got some type of constructive criticism, I mean, you can critique all you want, but if you've got some sort of constructive criticism of how to help me make these videos better, then by all means dish it on me, and we'll see what I can do. So this week, as we look at the market, we're still very much reading the tea leaves, and they are still very much pointing in one direction. But I don't want to get so scoped in or so laser focused on what the image looks like, right? So, like, if you look through a telescope and you hyper focus on the center of that telescope, you forget everything else. And I don't want to do that. And what I mean by reading the tea leaves is the example from Harry Potter. If you look at the bottom of a teacup and you look at the dregs, or a coffee cup and you look at the grinds at the bottom, if you hyper focus on anything that's easy to catch your attention, like what might be a dog, then taking in your own prejudices and your own thoughts and hyper focusing on the dog, maybe you misinterpret the dog, but maybe you also miss the other stuff that's in the cup. And we want to do the same, or at least we want to take the same approach for the market. We want to see the stuff in the market, but we don't want to hyper focus on what we can obviously see. We want to look at everything in general, take a step back, survey the entire thing, and then see what we can see from that. So I don't want to sound like a broken record, but not much has changed on the surface of the market. Powell's tenure at the Fed is still in debate. President Trump is still negotiating treaty after treaty. The next round of tariffs go into effect August 1st, I believe. And that's really where the news circuit ends. There's more to be said, but that's not, there's really nothing else being said in regards to those things. Now, if you want to know the full story, you have to take a step back and you have to dig deeper. So, because the news is not telling everything, gosh, because a lot of market analysts are not giving the full picture, I'm I took it upon myself to give you a better picture. Uh, I would love to say I give you the complete picture, but there's stuff out there that I'm going to miss. But my goal is to give you a better picture or a more complete picture than what you're getting on the talk show circle jockey um, circuit of things. So if you really want to know the micro and the macro markets, macro meaning like world based, micro meaning US based, but really if you go micro, it's really the impacts within your own community. So if you really want to know the micro and the macro market trends, you have to dig and consume content. And you also know how to filter that content because it's one thing to hear macro trends, but if you can't break it down into your own world, it doesn't really matter. So I watched a video from Secretary of the Interior, Doug Burgum, who's an energy whiz, right? But he said the US is committed to expanding the existing energy market inside the US in order to compete and win, his term, win the AI and tech race with China. Excuse me. That's a big undertaking because you and I both know. I mean, pick your state. I live in Texas. Pick your state, and your energy grid is behind the times. Like the energy grid is always taxed. In Texas, we get the early blackout warnings. Like when summer hits, don't Centerpoint had the gall to come out and tell everybody not to drop their thermostats to below 75, I believe below 75 degrees Fahrenheit last summer, while the guy who said that sat inside a controlled office space with the thermostat behind his head posted at 70. Um, so every summer we get the same warnings. Don't drop your thermostat. Don't be a drag on the energy grid. In the winter, it's kind of the same thing, but it's not energy, it's other stuff. So the Texas grid is behind the current pace of things. And that means it's not just Texas. I mean, the US is behind the pace of things when it comes to the energy grid. And this AI and tech battle or AI and tech boom we're seeing isn't helping. Have you heard anywhere about how much energy we need in order to keep pace? Not to excel, not to go above, just to keep pace. We need an energy increase the size of Japan. That's a lot of energy. And you also have to know that every single AI search uses around 10 times more energy than your standard Google search. That's a lot of energy. That's a ton of energy. And we don't see those energy increases unless we jack the production of oil and natural gas. Now, every technological advance is an oil derivative. All those microchips, every computer component, plastic, your phone, your fridge, my metal water bottle sitting next to me. All of that's an oil derivative in some way, shape, or form. We also need the natural gas because there are, yeah, we also need the natural gas. Many tech companies are now using natural gas to cool their growing servers because gas is cheaper than going through the water utility district. The size and involvement and heat of all the technological advances is increasing so rapidly that water's just not cutting it. Additionally, water costs more. Additionally, we still have utility districts and different states fleecing out their water or selling their water rights to all these other people. So water is always harder to come by. Natural gas is cheap. So we can expect that those increases, or we can expect that those products will increase over the next few years. My doorbell's about to ring because Amazon is dropping off a package. Um, and maybe not. Maybe you won't ring the doorbell. Nope, no doorbell. Um, so getting back to the market, Powell's tenure at the Fed is an unknown. And I'm sticking with my previous call. If he cuts rates, he stays. And if he insists on grasping for power and leveraging those rates against the Treasury Department, which is really against President Trump and against us, then he'll get replaced by somebody, really anybody. Quite honestly, the way, and I could say this crassly, but that doesn't help. So if Powell doesn't cut rates, anyone can sit in his chair and cut rates. We can hire one of those foolish, no smarts teleprompter jockeys to come in and do exactly like he's told and cut rates. That doesn't help us. We don't want the we don't want a yes man. I mean, we there needs to be somebody who can work with Secretary Bessent and President Trump, someone who can read the data and not be told the data, right? That's a key part of the job to get the data, view the data, understand the data, and interpret the data and adjust rates accordingly. We don't want somebody who's just going to cut without a cause in mind or without an understanding of things. That's not the point. But we also want somebody who wants to do the job as it needs to be done. Right? The Fed is a reactor. Whether you agree with the Fed or not, that's not the debate here. The Fed currently is supposed to be a reactor to markets. If this happens, then the Fed responds. If this happens, then the Fed responds. Currently, the Fed wants to control the narrative. This is what we want to happen, so this is what we're going to do. That's not any part that has no bearing on the double mandate that's that the Fed is instigated upon themselves or implemented against themselves. Powell is not doing his job by his version of how he should do the job or by our version of how he should do the job. So either A, he will cave and cut rates because rates should have been cut at least 6 months ago, or B, he'll get fired. Problem solved in a way. Um, Elsewhere in the news, President Trump is negotiating treaty after treaty on behalf of Americans. That's really good for everybody. That's good for the country. That's good for business. I've said all along, tariffs are not inflationary. One, I showed you proof of that in studies that have been done. Powell has the same data. He still thinks tariffs are inflationary. But Powell has also printed 40% of all currency in existence in a really short amount of time, and then had the balls to tell everybody, gee, I just didn't realize that would be inflationary. My third grader at the time understood inflation better than Jay Powell, the head of the Fed, said he understood inflation on national TV. Let that sink in. So tariffs are not inflationary. Tariffs bring people to the table so we can negotiate a better deal. Now, every country had a better deal than the United States, but through tariffs, the United States is negotiating better deals for Americans. That's a good thing. More on tariffs. There's been a little bit of a seeded panic narrative, meaning it's already been in the news. It's already coming from the news. It's already coming from these financial analysts that the next round of tariffs will bring more panic to the market. They are seeding the narrative so that when it happens, they can point back and say, see, we told you. Now, despite Trump or despite President Trump saying that we're raking in the money, which we are, and looking to decrease taxes and pay off the national debt, most people are still fearful of tariffs. And that just, it confuses me. Not the tariff part, it confuses me regarding people's reaction to it. And while I distrust everything the news says, some people are still on their hook and bobber. And that bobber's been under the water for a long time. It's not like we're going to convince them that the news is selling them a crappy version the first time. But on that, right, the first time tariffs hit, the herd freaked out. And they haven't learned to discern that what the news tells people isn't always the truth. It really just isn't the truth. So if the herd freaks out following tariffs 2.0, then we'll use that as another opportunity to buy in. Now, across my weekly readings of all the different stuff that I read, there's interesting advice coming from the people I trust, coming from the Contrarian Outlook group. But no one, and I repeat, no one that I've read has mentioned the External Revenue Service and tariff money. You have President Trump telling the news that the ERS is going to be a big thing and they are collecting billions in tariff money that he hopes to go around Congress and pay off the debt. Congress is great at spending. Congress doesn't care about paying back because now it's somebody else's problem. President Trump realizes that the debt is a huge drain on the economy. It's also a huge line item on the budget. So if Congress won't fix the problem, how do we go about that? Well, we can take tariff money and pay that off. And you might say that President Trump is going around Congress. I would kind of agree with that. But when our debt reaches this type of level and some other country owns our debt, that's a national security issue. That takes it away from Congress's wheelhouse and puts it with the president. So President Trump is, and he said this. This is not just me pulling from thin air, pulling from a really good dream. President Trump said his goal is to take tariff money and pay down and pay off the deficit in full. The goal is also to cut government spending, trim that down as far as we can. And the goal is also to decrease taxes as well as just do away with taxes. And I still believe the concept of the External Revenue Service, the ERS, being independent of Congress's credit card and the IRS's tax control system is a foreign concept to all of them. And they just can't frame it. They can't wrap their heads around it. It's been 100 years, really more than 100 years, since we have used tariffs to fund the government. About 100 years ago, no one paid taxes. It was all tariff money. So to have somebody propose this that it hasn't been done in that long of a time, they just can't wrap their heads around it. But that we would want to pay down the debt and eliminate taxes are concepts that just they're concepts that these financial gurus cannot process or understand. Because it honestly would change a lot of things. It would change the interest rate market and the economy and the stock market. It would do everyone better. Think of your tax bill and what you could invest when you had all of your tax bill back. Pick your tax bracket. What happens when you don't have to pay that level of tax anymore? What happens when you don't have tax anymore? We're not talking about state taxes and how they gimmick you there, but federal taxes. If you 20, whatever it is, 22%, 28%, like if you don't have that level of taxes coming out of your money taken by the government, and then on tax day you get the money back, It's just not taken out because it's yours. You would invest more, you would save more, you would spend more. That would be a enormous benefit for our economy and our United States. But nobody can wrap their heads around it. I don't know if they're scared and that it doesn't happen or what, but they just can't wrap their heads around it. My my trusted group, the Contrarian Outlook, will talk about the short-term yield curve and interest rates and the money market accounts and bond accounts and stocks and yields and business development and all these important things. And they'll talk about risk and reward. They'll talk about the comparisons between closed-end funds and individual stocks. And at the same time, they fail to mention the ERS in every publication and just pass it by. That's really strange to me. It's just all of them. I mean, of the group that I pay for and everything else I read, they all talk about finances and the bond market and the stock market and the S&P and the Nasdaq and the like all the stuff. And at the same time, they don't report on the ERS. And that's just it's strange to me. I can't wrap my head around it. So I'm reading Brett Owens' recent missive and looking for the ERS and coming up empty. And I'm reading his message about the bond market and the economy and interest rates and the battle between Jay Powell and Scott Bessent. And I'm looking for key things. Like I skimmed it, found nothing for the ERS, went back and read it, and was just floored by how much jargon and fluff was in this week. Like he made a case for something and I mostly missed it. And I could tell he was excited, but he lost me. And that it wasn't him just writing a fluff article that he had to write because it's his day to write it. It's not that. Like he was excited about what he was writing about, but he completely lost me. So I tried to process it and I tried to break it down, but still he lost me. So I took what he said and I put it into Grok. And I asked Grok, can you break this down? Enter. And Grok went back. Grok came back with, you didn't put anything in here. So I copied and pasted part of the article into Grok and then said, can you make this so a standard high school kid can understand it? And Grok said, sure. And that made it better, but even Grok struggled. Like Grok had the same thing, but he didn't break it down into a high school kid's language. But I persevered. I read through Grok, thought more about Brett Owens, thought more about the text, kind of have a better sense of things. And at the very end, I'm somewhat getting ahead of myself, but at the very end, Grok listed out some key takeaways that made better sense. Now, the one service I pay for is the Contrarian Outlook, and it's the basic level membership. It's the Contrarian Income Report. They do other stuff. It's $100 a year. I get weekly emails, generally Friday or Saturday. I'll get special editions. Occasionally, it's more emails. Like recently, it's been more emails, but those emails typically send you to. It's like here's the email with content. Go to this link with masked data so that you join a different service. I anticipate that stuff. I don't buy it. But this week, he seemed more excitable, right? And I also figure, like, if I'm having to do this to understand what he's saying, and he's so lost in the jargon that he doesn't realize he's distracting me, then I cannot be the only one, or at least Grok and I cannot be the only people that are struggling to process what he's saying. Like it can't be just me and Grok. And that's where, like AI, there are some things about AI that are great. I mean, they can take things that I said and make them better. They can also take what you've said and struggle to process through them because you didn't say them great to begin with. And whether you didn't say them well or whether you use crazy terminology or a mix of things, like AI is great in regards to how you program it, but AI can be really bad in regards to how you program it. And I could have sifted through Google, but Grok was easier. And I know some people that like ChatGPT, and that's fine. I mean, there's a paid version of both. At least I'm pretty sure there's a paid version of Grok, but I know there's a paid version of ChatGPT. But all of that requires energy. All of that requires technology to work, yes, but all of it requires energy in order for it to happen. Uh, so I read through Grok, and at the very end, he offers a rendering, like some listed key details, key takeaways, and those made sense. But they also reinforce what I've been saying since day one. If you're not invested through closed-end funds, it's a great time to start. Now, here are the rest of his takeaways. Some of this we've talked about in recent weeks. So, some of what we've talked about out of the herd, or maybe I don't know how we track this data. There's got to be a way. Sounds intrusive, but there's a record of $7 trillion being currently held in money market accounts across the United States. If rates drop, the interest rate on the money market accounts will also drop. So this is Grok's takeaway. One, money market accounts are like a safe place to save because he's explaining it to a high school kid. Money market accounts are like a safe place to save, but their 5% interest rate is dropping soon because of the rate cuts. The thought is that they'll drop to around 3.8%. Now, on my angle, the 3.8% is better than what you'll find anywhere else for a savings account. When I looked for places to put our money, I think the top thing I found was maybe 3.5, 4%. Right now, 4% is point two better than 3.8, but there was a lot of contingency based on that 4%. So the best thing I found was 3.5, but most things were at one or less. But even that is nowhere close to what you could earn through a closed-end fund. Point two, the Federal Reserve is likely to lower interest rates, making borrowing rates cheaper or make borrowing cheaper, but saving less in the rewarding side. So, on my take of things, rates will be lowered, whether Powell does it or somebody else. Right. So, as we think about that and we look forward, both we look ahead, we look forward, but also we look forward, like we expectantly look forward to lowering rates. What are the best deals that we can buy before short term rates drop? Point three, the US government owes a ton of money to other people, $36 trillion worth of money. That is a national security risk and a half, right? And because we owe a ton of money, we're borrowing with short-term bonds to save on interest. Instead of a long-term bond at 7%, we're doing short-term bonds. Now, on my end, no one no one in the financial world is talking about the ERS using tariff money to pay off debt. Congress spends. They're exceptionally good at it. The complaint is that there's a lot of pork fat, like a lot of overuse, wasteful spending. There's a lot of pork barrel spending that happens in Congress. Oh, you like my bill? Here's a kickback for you. Here's a kickback for you, right? And there's this massive chunk of our budget that goes to paying off the debt every month. But if we paid off the debt, then our debt wouldn't be sandbagging our budget and our taxes would go down. They should go down because we wouldn't have all this money needed to being generated to pay off the other stuff. Point four, a weaker US dollar is good for stocks. So investing in companies might be a smarter move than sticking with savings accounts. Now, on my end of things, a weaker dollar means things are cheaper, but that kind of sounds like inflation in a way. A weaker dollar means things are cheaper. High inflation means things are more expensive. Low inflation means things are more affordable. So a weaker dollar means things are cheaper. At least that's what's been said. I don't want a weak dollar. I want a strong dollar. I want a dollar that can buy, right? And part of that is wrapped around into inflation, especially of how you categorize inflation. Now, I asked Grok to explain a weak dollar, and he explained it. It explained personification of things. Uh, Grok explained it this way: if the dollar weakens by 10%, and again, like a high school kid can understand it, a $100 video game from Japan might cost you 110. But if you're a US company selling that same product to Japan or Europe, the Japanese might buy more because the game is cheaper for them. Now, whether I like it or not, it's the current market mentality. Therefore, the key takeaway is not how I feel, but how the market responds to a weak dollar system. And history has shown that when the dollar's worth goes down, the S&P value goes up. And we should pay attention to that. Now, whether you use it or not is up to you, but you should pay attention to that. But additionally, so fine, like the S&P value goes up, so you buy in expecting your value to go up. The average yield is 1.2 to 1.3, and that 3.8 doesn't sound that bad anymore. So I mean, you can sock away cash at 3.8 and get a better deal than 1.2, right? But you know what pays better than a 3.8% yield is a closed-end fund. So Brett goes on to say across lots of different articles that the current market isn't volatile, which you could make a case for. Um, but with tariff 2.0 around the corner, I don't know if that's going to stay. And in part, I hope it doesn't, which might sound crazy. I mean, I want fear and volatility to go up because it presents me with a great time to buy. You and I both know the herd doesn't learn. So when the herd freaked out with tariff 1.0 and the market dipped, it was a great time to buy. Now we're going to hit tariff 2.0. And you know the news doesn't tell the full story. You know the news doesn't tell the truth. And you know the herd watches the news. And all these people that don't report anything about tariff money and taxes and inflation and calling Jay Powell for his lies. And yeah, I mean, it's the same song and dance. And they've already seeded the narrative for volatility. So if volatility stays neutral or better than average, Brett makes a case for buying covered calls because they're more discounted and there's not a lot of volatility right now. So it's easier for them to make money. And that's a good point. But on my end of things, with tariff 2.0 coming in about a week from now, really a week from now, I don't want to buy yet because quite honestly, I'm hoping for volatility. I'm hoping for some fear and panic. Everything in the market right now is more expensive than when it was the last tariff fear scare we had. It's also more expensive than last month because we're in greed and the herd piles in greed and we want them to because it increases the cost of everything, right? So like you buy it at a lower price, the herd jumps in late and they help to propel that cost higher. We like that. At the same time, it also makes it more expensive for you to buy in because now it's higher in price. So if we have a little bit of scare and the market drops a little bit, then it's a cheaper buy-in. And I mean, honestly, if it dips like that, you know the herd. If it dips like that, the herd will panic. They will pull out because they're fearful of loss. The market will dip a little bit more, and it presents an even better time for buying. right? So while almost everything is a great buy now in front of rate cuts, in front of a dip, so in front of tariffs and that on my end of things, I mean, maybe it sounds, no, I won't say it sounds wrong. On my end of things with tariff 2.0, it's an anticipation that the herd didn't learn anything from tariff 1.0 and that the market will dip. Maybe it won't dip as bad, but it's my hope is that it dips so that things go down for a little bit. The herd freaks out and buys into their own dip for a little bit. Things go down a little bit more, and then it's a great time to buy. And then the herd gets over their panic. Everybody else gets over their panic of tariffs, and then the market takes off again. Right. So outside of a covered call, which is a decent strategy for really low volatility, what's worth our time and money? What would benefit us the most in a rate cut? And yeah, everything should go up for any number of reasons. With a rate cut, almost everything, really anything should go up, right? And we want that to happen. So the odds of you picking an amazing batch of funds pre-rate cut and then having a rate cut and seeing it increase in value, like that's you're pretty much set. You could buy almost anything. Although there are certain duds within each market, right? But if we can really increase the odds of picking a great batch of funds, where would we most likely see, goodness, a short term increase and a long term benefit? And I don't know why my allergies are flaring right now, but we're without sounding like a broken record, that's still the same stuff. That's still bonds and bond proxies. That's still real estate, BDCs, and utilities, and energies, and CLOs. Sorry, background wind and maybe a storm coming. Um, but the best place pre-rate cut is the bond and bond proxy market. Now, you can make a case for tech with the new golden age and Iron Dome coming into play and data being a huge thing. Tech is important. You could also make a case for oil. If you can find oil cheap, which is not right now, but if you can find oil cheap and at discount, that'd be great because that factors into everything. So, enough of my waffling. Let's check out the list for the week and go from there. All right. So, like everything else, like every week, I went through and updated the list, sorted the list. And next week, there we go. Next week, I've got to deep dive the list and do a significant update. And it should be easier because I will have a bigger screen again. But next weekend is the full system update and really updating all the target information too on all of these select funds. So all of these are significant. All of these funds have significant discounts based upon their track history. And how I sort them, I mean, the short of it, oil, I mean, yes, it's on the list, but at the same time, we're not going to find it. So I didn't put it in green versus these other things. So I sort the list by taking out anything non-monthly unless there's a good reason for keeping it there, which in Gabelli's case, you can make a case for it. I get that it pays quarterly. It's a generally cheap fund. They pay a pretty rich dividend. And currently it's on discount, and it's not normally on discount. So to find a Gabelli fund in discount territory is rare. So when it happens, it's gosh, when it happens, it is worth your time looking into it. The caveat for me is that it's not a monthly dividend. And I understand I bought ADX, which is not a monthly dividend, but I couldn't pass ADX by. For Gabelli, if we look at it's all pending that portfolio and account aspect, pending what you want to invest and all of that. If we divide that by 3 and get 4 cents, you can find a fund paying more than 4 cents a month So it's hard to pick up this fund. Even though it pays a great yield for its buy-in, it's just not going to make my cut. So now with everything monthly, we look at overall yield. And my goal has been to trim to 9% and above, unless there's a really great reason for picking something else up. We own NBXG in both the Roth and the cash portfolios. It has a dividend, it has a steady dividend, a dividend that I hope will increase, but it also is costing more than where we bought in. So I wouldn't keep it. That's me. How much is it increased? We want it to increase. We want to buy on discount. It's about $1 more. So it's not incredibly higher. Uh, it's not a crazy uptick in overall cost, but they also haven't raised the dividend. So for me, it's not going to make the list this week. Uh, let's see. Other things that will stay. The municipal bonds will stay. They are safe because there's extremely low default rates on municipal bonds. I get the apparent yield is that they are below 9, but the tax equivalent dividend is generally 10% and higher. And they're marked as dollar cost average buys because they are for us. Um, and honestly, I mean, I looked again today. Then, unless something crazy happens in the market, then our next round of funds, I would round. We own each of these. We own 3 different Nuveen accounts that are invested slightly different ways. All of them we own 900 shares of. In the next round of purchases, I would round out those to 1,000 and then go from there. All right, tracking up. HFRO sits now below 9% because their share price increased. Dividends remain the same. Um, it's the heaviest discount in a portfolio that I think gets overlooked because it's the heaviest discount, just doesn't seem to go away. They transitioned from bonds to real estate with very little fanfare, like very little information. And they're also very self-invested into the fund that owns or that manages the account. So you have 3 things working against them that they never really explain, and people are leery. That said, I think everybody's. Oh, I think the fears are. I think it's said. I think fears are oversold, in that people have bought in too much. They have square footage that is coming online with a lower interest rate market. It should take off. Um, for the dividend, I mean, this is really the best example because it has the steepest discount. If we're looking at this in terms of dollars, whether that's break even or a discount, so all of these are at discount outside of FSCO. But if it's a $1 to $1 investment, so like $1 invested, every dollar invested equals $1 of investment, your premium to discount ratio would be 0. There would be no discount. There would be no premium. Every dollar invested is $1 invested. If you're paying a premium, then you're paying more than $1 for everything you buy. This wouldn't be so. Like if it was a +1, you would be paying 1.01 for every share invested. Now, you could argue that it's pretty much break even, and I would. It's your fund and your portfolio, right? I've bought premium stuff because that premium never really changes. FSCO had this crazy discount and they've since closed it. And I've hoped that they would close it. But now it also makes it hard for me to buy knowing that it's going to be in premium. So we'll see what the new history shows of whether it stays there or goes back into discount. So if you're paying for something and it's a premium, say if it's a 5% premium, now for every dollar invested, you're paying $1.05 for every share you buy. Conversely, this at almost 56% off, you're paying 44 cents for every dollar invested. So you're essentially getting 2 shares for every dollar invested. So for that, it would stay on the list. And I get that it's below 9%, but it's crazily discounted, and I think it's undeserved. So it would stay. Additionally, when they switched from bonds to real estate, and not all the real estate was online and functioning and available for use. They cut the dividend in half. So if it, and I hope it does, if it came back, right? Like if they had real estate online rentable for use and we're paying the bills and generating the dividend, then the dividend should increase. And I hope that it increases, but the dividend would double if it goes back to normal. All right, DOY is new. It's the sister fund of DSL. And the difference is DSL, oh, there we go. I mean, there we go. They're both discounted, and they're not normally both discounted. The difference is the price. You get a slightly better dividend uh, amount with DLY, although the percentage rate is better with DSL. They're different portfolios. So picking it up would, even though it's a sister fund, it's a different portfolio. That's not just diversifying to have the same fund. It's diversifying to buy a new set of funds. Um, all right, so let me go back and trim this up. I've been talking and not trimming. So the diversification for diversification's sake, we already have one sister fund. We need the other. It is a different portfolio, at least on surface. It's a different portfolio. But we are already loaded with bond companies. Adding one more just doesn't sound like a great deal from my end of things, especially paying $15 for one. Uh, ZTR is on my sell list. We bought it on a roller coaster fund, knowing that it does top, but it also has valleys. And we bought a valley hoping it would top, and it's just kind of stayed in the valley. So we could buy it as a dollar cost average. We could buy it and bring down our overall total buy-in or overall cost to share. But I really don't want to. We bought CIF on a roller coaster. Now it pays a solid dividend on the roller coaster, but we bought it on a roller coaster hoping that it would go back close to $3 and then sell it close to $3. Oops, wrong direction. Maggie is same thing. It's up for us. It comes down to, is the discount close enough to its 1 year average discount. So if you think 911 is close to 979, which it is, it's a decent deal. It would be a better deal if it was 979 or lower. For us, it's not a dollar cost average move. HFRO is not a dollar cost average move for that point. Um, and yes, this is our actual portfolio, devoid of account numbers. This is our portfolio. So what am I looking? Meggie, 1257. It's about $3 higher. And that's where, when you buy into the market, you're going to buy at different price points. I mean, if we could always buy lower, we would, but then things wouldn't go up in value. So you kind of have to weigh it on how you want to weigh it for you. That's about, is that really $3 higher? Yeah, round about 12, $2 higher. My mistake. Goodness. So if it's $2 higher, that's not a lot in the grand scheme of things. It's a lot when you buy a lot, but at the same time, it's still not that much overall. $2 jump is not a huge thing. If we're talking about a $10 jump, still wouldn't be that big of a deal overall. It would be different based on what you have on hand, but you're going to buy at different points and create this average buy-in price. The bigger deal on our end of things is looking at the discount, whether if it's a good deal or not for the time. So it's a wishy-washy for me. It kind of depends on what else. Yeah, it's just sorry, wind picking up and more potential storm. It goes into this. This is higher than our buy-in price, and it's now at a premium, which is what I wanted. But my mantra has normally been don't buy premium unless there are some exceptions. And there are three exceptions to the rule, uh, none of which are on here this week. Um, let's see, there's ADX, PDO, and a third I can't think of. Um, DNP, ADX, PDO, DNP, for reasons I've explained in the past. But if FCO turns into a premium player full time, like it when it opened up, it had a steep discount and then it slowly narrowed over time, right? Which is what we want. We want the discount window to close. We want the value to go up. We want the dividend to go up. And it's still a great time for bonds and BDCs and all that stuff. And that's FSCO. But the question becomes, will it join my list as an exception to the rule because it's now just going to operate in premium territory? And you can argue that 0.41 is really close to zero. It is premium, but you can make a case that it's still pretty darn close to zero. DSL and discount, it's pretty much break even on our overall price, but it's a dollar cost average move, but the discount doesn't line up. That's the key point. So if I was going with dollar cost average only, it's a great idea. But by that measure, IGR, which is I want to say I want to say IGR is on discount this week. It's an international REIT. Um, IGR, I think, is on discount this week. It's for sure a dollar cost average, but its discount doesn't meet the metric. So we could buy it on a DCA principle, lower our overall buy-in average, but it doesn't meet the metric on discounts. And that's kind of the same thing with double line. It's the same thing with FSCO. It's I like the more you invest, or maybe this is still just central to me, but the more you invest, the more you realize you have certain funds that you just love and that you always want more of, regardless of price. But that's the trick with investing. It's one thing to like a company. It's quite another to invest with the best outcome possible. And that means you have to cut some things from your options list. So municipal bonds have an insanely great track record. The default rate is so low, it's crazy. And they pay a great 8% dividend, but they also pay this great tax equivalent dividend. Right? So long as the discount is decent, as long as the discount is decent and works and pending the right time of the market, it's a great buy. Real estate, same. Utilities, right? But if Maggie's discount changed, if it went to if it was maybe -5%, then it's not as great of a deal. And it's a really interesting utility company, but it doesn't meet the metric. So you're going to have to figure out your strategy and what you're willing to do and where you're willing to go. And it's okay to adapt that strategy. Like I have exceptions to the rule. They just always operate in premium territory. So when they when they hit that level, and even though they're premium, they're still worth a consider because they don't generally drop to that level. And I'm curious if FCO is going to be the same way. So for now, I mean, I would love to pick up another set of shares for it, but it's premium, and I generally don't buy premium. PIMCO, if we bought a PIMCO fund, it's diversification in bond land in the sense that it's a PIMCO fund and not anything else we own. But at the same time, does it really add anything of value? And I get it, it's a PIMCO fund. It comes by it's like brand recognition. PIMCO funds are generally in premium territory. PDO being that one of those three exceptions to the rule. They're generally in premium territory. But I don't know if it adds that much overall in a sense of I still have to buy it at whatever it is. So I as much as I like FCO, as much as I can argue that that's close to zero, If I'm trying to optimize what I buy, then it doesn't really fit the metric. EIC. Um, EIC is an interesting CLO fund, but we already own a CLO fund, and this again well-known CLO fund from the same company, it's like half the cost of the other. So why would I pay more? BRW is normally my companion ride with SCO. Like if I buy BRW, I'm buying FSCO. They both hit bond market just from slightly different angles. BRW, I've said in almost in every video I've made, I think it's a shareholder activist fund in the sense that it wants shareholders to be paid more, which is insane because I mean there are a lot, the current average across closed-end funds I think is close to 8.5%. So BRW's approach has been to buy majority shares in big name companies, BlackRock, which I'm not a huge fan of BlackRock, but they bought majority shares in BlackRock to force change through the board and then force change for shareholders. I like that. I mean, somebody who's willing to go to bat for me and get me more money and get everybody else more money, and I can get behind that. And BRW has taken off. River is it's still a bond fund, and it goes back to a couple things. Yes, it's a bond fund, and at the same time, we already own a lot of bonds. Two, they also invest a lot of that into BlackRock, and I'm not a huge BlackRock fan. So that leaves with HGLB, which is not as portfolio in a can as what I've explained on recent videos. I deep dived that last week. HGLB is marked on Closed End Fund Connect and Morningstar as being very diversified or kind of spread out in the swath of market labeled investments, but they're really not. Um, I finally tracked down their portfolio and dug into that. So they're heavy weighted where we want them to be. They're listed as a portfolio in a can and that they've got allocations across the board, but they're really not. The one big part of their portfolio that I don't know. I'm on I'm not on the fence anymore. I'm more in their favor. There's like 20, it's close to 30%, I want to say, of the portfolio is invested into a mid-wave wireless company. So the overall value of the HGLB portfolio is very much tied to how well the mid-wave wireless company performs. And it's I can see the vision in how they've aligned the portfolio. I'm also hesitant on the vision and how they've aligned the portfolio. 20, I mean, gosh, 25-30% is a bulk investment in a product. Now, you could say the same thing. Like, what if it was all tied into Apple, Meta, Alphabet? Like, you could make a case for that, but it would have the same connotation. When those stocks swing and they dip, your portfolio is going to dip because you've tied them together. And I don't know if I'm comfortable with that. I'm more comfortable with it than I was, but at the same time, I don't know if I'm comfortable enough to buy it. Um, so I'll leave it partly because of discount, but I'm uncertain. The last two are collateralized loan obligation companies, and they are some of the best in the business. And I went into this on last week. There is fear in the CLO marketplace because of interest rates. And I mean, you could add the economy, but the economy is kicking along. Interest rates. So when interest rates rise and fall, that kind of puts volatility in the CLO market. There's doubts about people being able to pay back debt. Um, and I'm forgetting one thing. Maybe it'll come back. Hopefully, it'll come back. Let's see. Interest rates, overall volatility, economy. Ah, yeah, the weak dollar. And people get overly concerned of their debtors being able to pay back the money. And when that volatility hits the CLO market, people sell because they're worried about people being able to pay back the money. Now, I can explain why they've dipped, which is what I said. But at the same time, it doesn't mean I understand why they dip. The economy is chugging along. Cutting interest rates would help everybody. And the dollar being weak, I think, really is perception. So if the market puts out, hey, the dollar's weak, and all these people push into stocks, um, I mean, how much of that is controlled narrative and how much of that is true? So if the dollar is weak, then people go on the offensive. Like if it's a weak dollar and things are cheaper, then people are going to push into the S&P and stocks because they see it as a better buy, is what is said. On my end of things, if rates are high and a rate cut is good on the side of bonds and bond proxies on all things loans, and the market has already dipped in the sense that on CLOs in particular, if the market has already dipped, I mean, who knows how much it'll dip further with a tariff scare. Um, but I don't share that fear. So if it's me, if I'm investing tomorrow and I'm not, quite honestly, because I'm waiting for another tariff dip, and if the tariff dip doesn't happen, then we'll invest in August. But knowing the herd and knowing the panic they embody and realizing that they didn't really learn anything the first time from tariff 1.0, I'm I'm anticipating some type of market volatility and dip following tariff 2.0. I would buy the dip. So I'm not investing tomorrow. I'm expectantly buying a dip, which would be next week's video. Um, but if I'm buying tomorrow, knowing that rates are going to drop, whether Powell likes it or not, um, the best place for us to be is bonds and all thing bond proxies. So that's everything on the list. But if you were going to hold me to, you know, if you're going to hold my feet to the fire and force me to actually pick a list, not of things that I think are great ideas, but of stuff that I would actually buy, municipal bonds for sure. I would pick up more HFRO. Meggie is the most expensive thing on the list. You can argue for the discount. It comes down to money. Um, the more you spread out your funds, the more you limit your ability to gain in places that you want to gain. And yes, we want all of these funds to go up. But let's see if I can explain it this way. So we'll say this cell equals that amount minus the sum of these amounts. So I would pick up more OXLC. I've bought 200 sets. The last two times I would pick up another 200 set. ECC would be another pickup. I'd add 200 shares there. HLB, I don't know. BRW is a good buy, but it's also more expensive than the last time we bought it. HFR is close to where we've bought it before, or close to our current average. These I would round up to 1,000 shares each. So between three funds, there's now 3 grand to spend. So, oops, 100 there, 100 there, and we still have money left over. But if we're not spending money in Meggie, now you've got 1,800. Now you can increase and kind of play the odds. And you can look at your overall dividend between. So if you look at no investment into Meggie, you're looking at, yeah, 1,300 a year, which is like, there we go, about 109 a month. So think of this, no investment into Meggie is 109 a month. But if you invest into Meggie, now you're looking at 104 a month. So it's about a $5 difference. Not huge, but a difference. So if you want to streamline it further, nope, that's not helpful. RW 772, 70 cents higher, not a big deal. Maggie, $2 higher. HLB, 771, 40-ish cents higher. Maggie, yeah, $2 higher. So if we want to streamline it even further, I mean, the difference is picking up 200 shares here. Hmm. Yeah, that's really, I mean, I don't want to waste your time. If I'm going about, and I don't want to waste my time either. It comes down to comfort level and where you, I don't want to just like throw strategy under the bus. Maggie's an interesting pickup where it is. Um, oops. And I could for sure advocate for it. There we go. But if I'm going to hyper focus on the bond market and interest rates and what that does to the bond market, then I would go with this. And we'll see what it looks like next week. And we're not investing tomorrow, but hyper focusing on bond and bond proxies, knowing that the herd will, it's, I don't, gosh, it's both the overall outlook for the market, interest rates and bond prices, and how they relate. It's also like, so when the herd hears the dollar's weaker, stocks are better, I would anticipate they push into the S&P. The the other part of the picture is where that 7 trillion in a money market fund is housed and what it's generating. So if they've tucked away money, loving a 5% yield, a lower yield does not sound as fun. And knowing that the S&P pays a 1.2 or 1.3% dividend, generally paid quarterly, that's not that great either. The better setup for the herd, and something that's still very liquid, the better setup for the herd is pouring money into the municipal bond market, where it's a very steady rate market. The yields are very consistent. The tax equivalent dividend sounds amazing. Like 8% compared to 1.2 sounds amazing. 10% sounds even better, right? And that's even better than 3.8 and better than 5. So a steady rate, very low risk setting, municipal bonds sound ideal, but so do CLOs. I don't know if the herd would go for a CLO fund. if you think of risk and volatility and threat of loss, now the default rates are low, right? But if you think of volatility and this dip we've seen in the CLO market, is probably the herd selling because of weaker dollar and uncertainty and all of that other nonsense. So it's a great time for us to buy because the herd's not there. And pushing into stocks where everything else is going to go up, that doesn't help because it just doesn't pay well. So on the bond end of things, lower rates means higher prices, and the herd will be late to the party. So if we buy cheap in comparison, if we buy bonds now while they're still cheap, although they have gone up in price, if we buy bonds now while they are still cheap and still paying a fat dividend, and I think they'll continue to pay a fat dividend. When the herd gets here and closes the window and raises the price, that puts us in a better position too. So stocks look like the easy answer. And NBXG and ADX, like ADX is not that far off its average, but it's now $22 a share. And NBXG is kind of the same boat, like two-ish dollars ahead of where we bought it, which is great, but they haven't raised their dividend yet. So it's still a great buy at 8%. It's just not as good of a buy as if they raise their dividend to 9 or 10%, which might sound wishy-washy because I guess the goal is to buy, like when we bought NBXG, I'll go back. When we bought NBXG, we've bought it at varying rate, but we've also bought the discount. So it's close to a 9% yield. Let's see. NBXG has one of the better discounts, right? And close to an 8% yield. So it's not like it's a bad buy. It's just if we're looking to optimize money in and get the best outcome out, for me, it's not a buy this week. We'll see what it looks like next week. So, but if you were going to hold my feet to the fire and force me to buy something tomorrow, this is what I would pick. And that also depends on what you have to invest, right? I just picked 10 grand out of thin air. If you have more money, either you have the same list and you invest more, or you're a little more able to add additional funds. If you have less money, now you have to really hyper focus on how your strategy plays out. Do you go municipal bonds? Do you pick real estate? Do you go collateralized loans? Or do you pick a hodgepodge of things? So it really is central to you. But if this is me, and I'm not buying tomorrow, but if this is me, this is the set I would buy. My I read another article that was like it's really there are a lot of investors who are sitting out of the market because costs have gone up. And that's understandable, right? But it goes back to the plan is to buy over change, right? And sometimes you're going to buy higher, sometimes you're going to buy lower. You can't control that. You can by not investing in it, but you want stuff to go up. So if you buy low and now it's high, you're going to be waiting till the market swings to find it at a lower price again. So you're going to have to buy higher than your buy-in price at some point. So there are a lot of people sitting out of the market because they don't want to pay more for stuff. And I understand that. And we're not sitting out for that reason. This would be our week to buy, but we're not sitting out for that reason. When I look ahead and I see tariff 2.0, knowing how the herd reacted in tariff 1.0, and tariff 2.0 hits on a Friday. So now the media has all weekend to sell how all the market's going to go haywire on Monday. I can watch the market and see what happens on Monday. And if it goes haywire, I can see what happens Tuesday. And I can buy probably midweek. We'll see, right? We'll see what the herd panics or how they panic. But 2.0 happens on Friday. The media has the weekend to hype it. Monday morning, we'll see what happens with the market. And if the herd panics, which that's the narrative that has been sown already, if that happens, then we'll see the market dip. And that's the time to buy. And whether it's So like if that's the market Monday morning and it falls out and then it gets worse on Tuesday, you cannot time the low, right? So whether you buy it here or lower, can't time that. You can try to, but you can't. The herd is finicky. So if we have that panic and the market dips at any point below normal, that's the time to buy because history has shown that when the market dips, it always comes back better. So that's at least my strategy and my rationale for now. We'll see how that changes over the next week, and we'll see how that changes on the next video because I'll make the next video after Tariff 2.0 goes into effect. So whatever you have for the week, I hope it goes well. If you would please leave a comment because I do like interacting with people. Leave a comment. Tell me what you're doing. Tell me what your strategy is. Share your strategy with other people. Uh, yeah, and if I can make these videos better, then by all means, drop me a note on that as well. So whatever you have for the week, I hope it goes well, and I will see y'all next week. Bye bye. And there we go. All right. Bye bye.